The Money Show.
Personal Finance with Warren Ingram.
Well, don't forget, if you've got a question for Warren tonight, you can send us a voice note if that's easier on 072 702 1702. Calls too, of course, on 011 883 0702 and 021 446 0567. Tonight, we're concentrating on how to build and improve your credit score. Warren, good evening. Quite a lot of myths around credit scores, actually. I suppose we need to start with, what is a credit score? We all know it's very important, but I have no idea how they compile. So what is it?
And we often don't even know why they're important. We just know everyone tells us they're important. It really is a score, and very often it starts, for all of them, it starts at 0, and then it goes up to, in some cases, a maximum of 743 or 999. So it depends, because we get these ratings from credit bureaus. So depending on the credit bureau, your maximum score will be one of those, 743 or 999. And what happens is a credit bureau will give you a ranking, and the higher the ranking, the better your credit score. In other words, the more creditworthy you are. And it's a score that's then used by banks and other businesses to determine if you're a good person for them to lend money to, or are you going to be risky, and equally, should you be avoided as someone to lend money to. So your statement's right, Stephen. It's a critical number for us if we live in the world of debt.
Okay, so if your score is higher, the better it is for you. You are more likely to get credit.
Exactly right. So your starting point is you're not applying for debt, for no reason. You're looking for debt either to buy a car or a house or something, and so you want the highest score possible. If you do, it means that the institution that does the lending, so usually a bank, will say that's okay. We'll give you the debt. So that's step one. The higher the score, the better chance you've got of actually just getting debt. Equally, if you've got a high score, it might mean that they give you a slightly better interest rate, because the banks won't always just say no. So if you've got let's say an average score, you only score 600 or 650 or something, it doesn't mean that the bank won't lend you money at all, but they might say, this is quite a risky person for us to lend money to. So what we're going to do is we're going to charge them a higher interest rate, because we have to get paid for the extra risk that we're taking to lend to this person. Whereas someone else who's got a better credit score and is perceived to be lower risk, well, we can lend to them, and we can charge them a slightly better rate because our risk is lower, and so we don't need to be rewarded for taking extra risk.
How important is how much money you've borrowed in the past? So if you're starting out, say you're just leaving home, you just finished school, and you have never borrowed money in your life, which is very likely. When you turn 18, you won't have been allowed to borrow money before. What happens then?
The irony in all of this is that you might be a fantastic credit risk. In other words, you're somebody, in your example, you've never borrowed before, you've never needed to, and you've got positive cash flow. So you've got no debts, you don't owe anybody any money, and you want to borrow a little bit of money, and so you go and apply, and it turns out that you get turned down because you've got 0 credit score, or they might give you a score of 100 out of 700 or 100 out of 1,000. So that's the one situation. Or on the other side, you might be somebody who says, well, I'm happy to just start work, and I don't borrow from anybody. And at the age of 30 or 35, you've built up a nice deposit on a house. You've never borrowed from anybody because you've been saving diligently. And then again, you pitch up at the bank and you say, I want to borrow money to buy a house. And then they go, well, we've never heard from you before. You've never borrowed from us before. So, you're a high risk person. We don't want to lend you money, or we're going to charge you a fortune in interest because you just have no credit history with us.
Okay, then how do the banks know? So for example, I'm going to a clothing store and I want to put something on HP, which I know from last week we shouldn't do. And then so I want to do that, and they check my credit score. Where does the information that is used to compile my credit score come from? What I'm really trying to get to is, I've always believed the bankers are in it together, and this is clearly proof that they are.
There is so there are these businesses. They're called credit bureaus, and what they do is they build up a history of your treatment of your debts, and what they look at is what debts have you had in the past. So have you, for example, did you start out with a cell phone account, and how did you pay that cell phone account? Were you paying it on time with the right amounts? You didn't underpay. Or alternatively, were you irregular? So you were a bit late with payments or missed, every third or fourth one. And if you were disciplined and you paid on time and you paid what was required and you always paid the right amount on the right day, then that means you've started to build up a history. And that history stays with you for a period of time. And that will then start to build up. Equally, if you were late and irregular, then that history also stays with you and starts to build up over time. And that will be a bad score. You'll start to build up a credit history that's not good and therefore compromises your score.
Okay, so then I've never sort of seen. So if, for example, I have something that I pay for monthly, so say just a cell phone subscription rather than pay as you go, or prepaid rather. So if you have an account that you pay every month, the fact that you pay that, even though you're never actually in debt, so in other words, I'm not paying back money, I'm paying what I owe every month, that goes towards the credit history?
Yeah, that's and it's often one of the pieces of advice that we're given is if you haven't got a credit score, open an account. So not a debt. Don't go and borrow, but you can open an account and then start to build up a history of using that account correctly and paying it off as you go. And the reason why that works is because let's use the cell phone example. You're actually using the cell phone services for that month, and then you're paying them at the end of the month. So in a kind of roundabout way, you are borrowing money, I would guess, from the cell phone company because you're using their services, and then you have to pay it back and pay what you owe. And so building up a good history over a long period of time of paying what you owe is a good way to then build up the credit history. Equally, that if you don't do it, I think maybe one consolation here, if you've got some history of not paying your store cards or your accounts on time, that history starts to fade as time passes. In other words, it might really harm your credit score, in the first 3 months after you've not stuck to the program. But after 18 months, it harms you less, and after 2 years, it might disappear from your history. So fortunately, time is on your side as you go with these things.
Okay. The biggest debt most of us will have is probably a bond repayment or a mortgage. Does that get a greater weight if you are paying that regularly because it's so big? What I'm trying to sort of understand is people who, I would just presume that people who are making a decision about whether to lend Stephen money or not, the first question probably wouldn't be, is he paying his cell phone? Is he paying his bond?
Exactly, and because it's such a large amount, if you are sticking to the repayments, or if anything, maybe paying a little bit more, and so doing more than what's required, that will really help you on a credit score, because it shows the banks that you're able to juggle the needs of paying for your food and all the other things that you need to do, as well as your mortgage, and you're doing it on time or ahead of time, and so certainly that will boost your score quite a lot. Also, if you're not using your debt facilities to 100%, in other words, you've got a mortgage, but you owe 3 million rand, you're only using 2.7 million, and you're paying it down. It shows that you're not, absolutely at the maximum limit all the time. So a bit like driving, you don't want to drive your car at maximum speed all the time. That's going to break your car. And it's the same with debt. If you have a facility which allows you to borrow 3 million, but you only use 2.7, it means you've got room to breathe, and it means that you're obviously in control of things. Then equally, that you're paying it down and on time, that starts to boost your score. And the longer you do that, the longer you have that relationship with the bank, and the longer that bond goes on, so your history gets improved, because they'll look at that and say, you've had a bond for 8 years, you've never missed a payment, you're paying a bit of ahead of schedule. That's a very good score. That's a very good idea. Whereas, as you say, if you've got a cell phone account and you're spending 300 Rand a month, very different story. Even though you're disciplined, it's not going to rank as high as paying off a 3 million Rand bond.
Sorry for the technical questions about how it works, but if I have a bond with Bank A and now I'm trying to get credit from service provider B, how on earth, isn't there a legal issue that they now know what I'm doing on my bond, if you see what I mean?
Yeah, so you need to be very careful here. You have to be clear and transparent when you're borrowing money or you're applying to borrow money, because you might think no one knows what's going on, but the credit bureaus are collecting your data, and so it will be found out if you're saying, I've got no debt. Meanwhile, you've got a big bond with one company, and you're going to go and borrow money from another company to buy a car. That will really harm you if you start to lie on your credit applications. That's going to be really detrimental. So don't assume that if you deal with two different financial institutions that your data is not being collated. The credit bureaus work across all of these institutions, and so that's the very first thing that a bank will do is they will take your credit application and then input it into the credit bureau to see, are you creditworthy? And if that comes up that you've either forgotten, which it'd be quite tough to say I forgot about my bond. You should know about it. In other words, you're not reliable, you're not honest. Then that's going to either prevent you. They might not lend to you at all, or if they do, they're really going to charge you a huge interest rate.
Does the type of debt and the variety of accounts matter? So in other words, if I just have a bond and a cell phone account, so that's not very diverse, am I going to get a different score to if I have a bond, a cell phone account, a car, this, a Foschini, that, or whatever?
I feel like I'm going to sit on the fence a little bit. So the variety of accounts does help you. So if you've got, to use your example, a few different accounts, including a bond and a credit card, etc., and you're paying them all off on time, and you're managing that, so you're juggling that load correctly, that will certainly count in your favor, provided you're not using up your entire salary to pay off all these debts. So if you're managing your accounts well and you have got a variety, and you've still got the financial capacity to deal with that, then you're in the pound seats as far as getting probably a brilliant credit score. Equally, if you've got a whole bunch of different kinds of accounts, and you're using up your entire salary to pay them all off, then that might start to harm you, because it means that you actually can't afford the debt that you've got, and at some point the road is going to run out on you, and you're going to get yourself into trouble. So it is good to have a variety of accounts, and certainly managing them well and managing them affordably will enable you to get a very good credit score, and that might help you improve interest rates on home loans and all of those things. So I do like the having the variety. I think it works, but just be very careful that you don't suddenly get yourself into trouble with too much debt.
We're speaking to Warren Ingram, the co-founder at Galileo Capital, a certified financial planner. How to improve your credit score tonight. Your questions for him, 072 702 1702. I've got a slightly different question. It's from JP. Warren, he asks, my financial advisor is offering me a unit trust that charges performance fees. I see from the information they sent that this fund has a total expense ratio of 6%. This seems way too high. 6% too high? We'll find out from Warren in just a moment.
The Money Show. Personal Finance with Warren Ingram.
We're talking about how to build a good credit score tonight. But Warren, first JP's question. My financial advisor is offering me a unit trust that charges performance fees. The fund has a total expense ratio of 6%. It seems high. Is that quite high?
That's I can't use rude words. It's very high, very, 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 very high, Stephen. Very high. So maybe just to explain, when you buy a unit trust, the product provider, the fund manager, will typically charge you a fee somewhere around, let's say for a fund that invests in shares, they'll charge you a fee of about 1 to 1.5 or 1.7%. And if they only charge you that annual management fee, that's the fee you're going to pay. You might pay a little bit of extra money for transaction costs within the fund, and that's how you get to something called the total expense ratio. It's all the fees all in. But when you come to a fund manager that says, well, we're not going to charge you a flat fee at just a percentage of 1 or 1.5%, we're going to charge you a performance fee. What they typically do is they charge you, let's say, 1% or 1.5% or something per year. And then they actually take a share of the profits that they make on your investment as well. And typically it will be done over, let's say, a typical 3-year period or a 1-year period. So they won't just do it for a profit generated over a month. They'll calculate it over a longer period, and then take a portion of that as a performance fee. And the idea is, you don't pay that much when the growth is not good. So when the growth is poor, you pay less. But when you've generated a lot of growth, then the fund manager takes a portion of that growth as part of the kind of win-win explanation. Not my favorite way of charging. It's what hedge funds do, and that's why I don't invest in hedge funds. The richest people on Wall Street are the ones that charge lots of performance fees, Stephen. So I think it's kind of a universal thing around the world, is that the fund managers that charge performance fees tend to make themselves a lot of money. They become the ones that buy the big mansions. And to me, I much prefer a fund that charges a flat percentage, 1% or 1.5% or something like that. So yes, 6% is very high. It's not unethical from the point of view that all of this stuff is disclosed. It's very transparent. You know exactly what the fees will be before you go in, and they are transparent in the way that they calculate them. So they're not doing anything dodgy. And of course, it's your choice. If you're JP and you want to go in, you might look at the fund and say, it's delivered fantastic growth, I want to participate. What you need to remember is you're participating at a time when they're charging 6% after they've delivered great returns. So you're coming in, there's no guarantee that you're going to get great returns in the next 12 months or the next 3 years. So you might be paying a high fees for performance that you didn't benefit from. So you've got to be very careful with performance fees. And some fund managers try to make it fairer, where they charge nothing when your fund hasn't grown, and maybe they let you recover some of the lost growth before they start to charge you fees again. So there are fund managers that try to make this fair. But I mean, the simple, very quick answer to someone like JP is 6%. Yes, that's very high for a total expense ratio.
It does sound like it. We've got a voice note tonight on 072 702 1702.
Good evening, Stephen, and the 702 listeners. I just wanted to ask, is it possible for maybe a bank to be charged for reckless lending to an individual? Because I don't see, is there anyone regulating the banks in this regard, rather in terms of reckless lending?
It's a great question, Warren. I mean, someone with a very bad credit score suddenly gets given a lot of money, often a lot of advertising around this. I presume there's something you can do?
So this is regulated under the National Credit Act, and why I like the question is because I don't see. I mean, I can't recall in the last 2 or 3 years kind of splashy headlines about the regulator taking the banks on and some banks getting fined for reckless lending. So it feels to me that, yes, the act might be there, the regulations are there, and we see the regulators being very strict on things like FICA, where they do, identification and money laundering protection, all of that stuff. But I just don't see lots of, kind of this reckless lending regulation. So it feels to me that the laws might be there. I will say I'm a little bit ignorant as to how effectively they're being policed and whether the banks are getting into trouble for this. But if we look at how many people are in severe debt trouble, my kind of anecdotal evidence is I don't think that this is being regulated as well as it should be.
We've got a minute left. How do you build a good credit score very quickly?
The one thing you can do is you can go to a bank and say, I'm going to give you in a savings account 2,000 Rand, and I'm going to let you keep that as let's say as a surety. It's called a secured loan. So it's my money. I'm letting you hold on to it. Please, will you give me a credit card and give me a credit limit of 2,000 Rand? If I get myself into huge trouble and I can't pay off the debt, you've already got my 2,000 Rand as surety. And so for the bank, this is extremely low risk. This is a secured loan. But what it allows you to do, is to start building up a history of actually managing a credit card well and showing the bank and the credit bureaus that you are disciplined and good with money. So if you don't really like the idea of borrowing, you can then use a secured loan, and that kind of gives you a very nice safety net, and then start to build up the credit history, maybe just for the bond when you need it one day. Sure. And then
Warren,
maybe just make sure you don't overborrow.
Warren, we'll have to leave it there. Thank you so much. Really do appreciate it. The co-founder of Galileo Capital.